74% of home buyers use a loan to purchase their house. 25% of homeowners have $0 saved for when something breaks, and most buyers still only talk to one lender before picking their mortgage. Today, I'm fixing all three of those in about 15 minutes. Welcome back to Routes in Real Estate. I'm Anthony Armstrong, and this is your playbook for buying a home the smart way. And if you're new here, I just want to let you know, I spent 6 years in the NFL running routes. Now I help people run routes through the real estate market instead. I've been doing this for 12 years with Next Home on Main here in Frisco, Texas. But on the field and in this real estate market, it's the same principle. Know the field, know your coverage, know your options, get to the opening before somebody else does. And today's episode is built off of a graphic I saw from List Reports. It's breaking down some of the simple home buying steps into some plays, and I got 4 of them for you. But we're not going to call them chapters today. Like I said, we're going to call them plays, and I'm going to call each of these like we were in the huddle when I was playing the game. So let's get this thing started. First off, let me show you what that graphic looked like. We'll get a little look at that, so we can get an idea. This graphic right here, researching your options, getting your more than one mortgage quote, getting pre-approved before you start your house hunting, and starting your rainy day fund. Those are your 4. But let me call them my way. Let me call these plays. So our first play, we have Right Scout Motion 92 Slide Pro, conventional post, FHA flat, VA wheel, USDA corner on 2. So translation for anybody who doesn't speak football, that means research your finance options. Here's a myth that I want to kill right now out of the gate. Most people think they have to put 20% down and have to have perfect credit to buy a house, but that's not true. 74% of all home buyers financed their purchase last year instead of paying cash. Now let's break that down a little bit further. 92% of first-time home buyers financed. Only 70% of repeat buyers, because repeat buyers are often rolling equity from a previous home that they've sold into the next one. So they're able to bring a little bit more cash. Here's an interesting side note. 26% of all buyers paid cash. That's an all-time high. That's likely tied to the fact that over the past few years, home prices have been higher. There's been a lot more equity inside of homes. So now when people have sold, they were able to take that equity out and then roll it into a new property. A lot of them decided to pay cash to avoid having a mortgage. That's also, why cash offers are going to be super competitive, because they're able to mitigate the process of having to get a loan and the credit and the approval and things of that nature. But that's not you and me. We're talking about financing today. So here are your 4 main lanes to consider. A conventional loan. That's the minimum credit score requirement around 620. Most lenders will want you to be 640 or higher. Down payments can be as low as 3% for first-time home buyer programs, and 5% is standard. So let me drop this in here. A first-time home buyer is somebody who has not owned a property in the last 3 years. So you can be a first-time home buyer and buy a property at, let's say, in your early 20s or your late 20s, whatever it is. Then you don't own a property for 3 years, and then you come back in your 30s and buy a property. You can reapply for first-time home buyer programming. So if you bought a home in the past and you don't currently own now, it's been past 3 years, you qualify to be a first-time home buyer. Your second lane is FHA. Your minimum score on FHA loans that they're looking for in credit is a 580. That's going to get you to go about 3.5% down. If you have a score between 500 and 579, you can still qualify, but most lenders are going to look for you to bring more to the down payment, likely 10% down. And this is backed by HUD. It's a government-backed loan, and it's the most common on-ramp for first-time buyers with less than perfect credit. Here's a cool one. It's for our veterans, active duty, and surviving spouses. That's your VA loan. There's no official minimum credit requirement, and there's there are generally no income limits. No, there are no income limits, but there are pretty good limits on how much you can afford. The lenders typically want to see you have a credit score between 580 to 620. There's 0 down. That's the big one. 0 down payment for our veterans, surviving spouses, and active duty. No mortgage insurance. And if you're eligible, this is generally the best deal on the table. If you want to live out in the country, those more rural areas, look into a USDA loan. Zero down as well, but it's only going to qualify for eligible rural and suburban properties. It's going to go by population. So yeah, USDA.gov, that's the website you go to. Lenders are going to look for credit scores that are going to be around a 640 for automated approvals. One more thing worth knowing, the average FHA borrower has about a 680 credit score. The average conventional borrower has a score closer to 750. That 70-point gap tells you exactly why FHA exists. It's built for buyers who are credit worthy, but they're not quite at those elite scores yet. So it helps them get into home ownership and start building equity. But here's the bottom line on this first play. 3 out of 4 buyers use a loan. If you've been holding off because you feel like you need to have perfect credit or be able to have this huge down payment, that's not necessarily the case. It's a myth that's keeping you out of the house that you could probably afford. And like you've seen on previous episodes, there's more inventory in today's market than there was in the past. So now as a buyer, you have more options. Now let's move on to the second play. Play number 2, gun, trips left, shop, motion, 3 deep package, broker cross, big box, curl, Freddie special. Ready? We're going to go on 2 on this one. Ready, break. This one is make sure you get more than one mortgage quote. All right. Make sure you get more than one mortgage quote. This can make you a little bit upset. Freddie Mac is the big mortgage giant. They did research on this. A borrower who gets just one extra rate quote can save on average $1,435 over the life of a $250,000 loan. If you get 5 quotes, that average savings jumps to $2,914. And when the rates are more volatile, like they have been in these last couple of years, the gap between lenders on the exact same day can be even further. It can be a much wider gap just depending on the lender that you're working with, which means that the payoff for shopping around gets bigger rather than smaller. Now, I don't really want my buyers to go off and shop for 5, 10 different lenders. Generally, rates are going to be similar. Now, there's going to be some small nuances between different fees that one lender charges versus the other. And that's where you get into the details behind things. Lenders I try to refer are high quality. They're going to do things the right way and they're going to give you good information. But it still is helpful for you to get a second opinion just to make sure that you're seeing what you're seeing. But here's what part of the research that stings. The research shows that 77% of buyers apply with only one lender. They're leaving some money sitting on the table because shopping around can feel like a hassle. I mean, I get it. You have to open up your whole book. You have to give in W-2s and bank statements and tax returns and all types of information for them to tell you what you're approved for. But let's talk about the difference between a mortgage broker and a big box lender, because this is where it can trip people up. A mortgage broker is someone who is going to take your mortgage application and they can shop it across a multitude of different investors and different products to try to find something that can fit for you. There's a network of wholesale lenders with that one single application. But then if you have a direct lender, think about your bank or maybe a national big box lender, they only offer their in-house products. The rate gap between lenders on the same borrower profile can run up to 0.5%. So on a $400,000 loan, even a 1/4 point difference adds up to around $18,000 in interest over 30 years. Brokers typically charge 1 to 2% of the loan for their fee, and sometimes that's paid by the lender instead of you. Direct lenders skip that broker fee, but they may have less flexibility on the pricing. So there's a trade-off. If you're getting a quote from a broker, it's good to get a look and understanding where those fees are going to be at. And the same thing on the opposite side. You may be able to qualify for a lower quote or a lower interest rate if you're going with a broker, even if they do have a 1 or 2% fee. Both of those channels can close in about the same 30 to 45 day window on range, and the idea that banks are faster isn't really backed by the data. Brokers tend to win for self-employed buyers, investors, and jumbo loans because they generally will have a wider product access, and direct lenders can be just as competitive for straightforward W-2 buyer with strong credit, existing banking relationship, things of that nature. But here's the bottom line. Get at least 2 or 3 quotes. It costs you nothing but a little bit of time, and the data says over time it's worth over $1,000. Why not save a couple dollars when you have an opportunity? All right, now we're getting into the third play. So just to recap, you've researched your financing options. You're going to get more than one quote. Now here's play number 3. Make sure you lock in on this one. Green, right, clear, motion, 45 slide, pro, pre-approved, go, letter in hand, streak on 1. AKA, get pre-approved before you start house hunting. This one connects directly to what we've been talking about. There's a difference between a pre-approval and a pre-qualification. Generally, a pre-qualification is something that's quick. You self-reported some numbers. The lender can give you a brief idea of where you may fall based on what you've shared. But when you go through a pre-approval, that's the real deal. You're looking at a hard credit pull, verified pay stubs, W-2s, bank statements, and this is where this is the letter that sellers want you to have. Well, other realtors want you to have whenever they're saying, "Hey, you ready to purchase? Have you been pre-approved?" They're looking for this letter to know that you've been through a process to verify your funds and know exactly what you're going to be able to go out and search for. In 2024, purchase mortgage applications were approved at roughly an 86% rate. So pre-approval isn't a rubber stamp, but the odds do favor some, the buyers who come in prepared. So let me break it down to you like this. If I'm selling a property, and I do have a property for sale, it's a property up there in Melissa, Texas. With this property, if I'm the seller, I'm going to have a buyer come in, and if they're saying, "Hey, my buyer is pre-approved, here's the pre-approval letter. This is the offer that outlines that we can offer this price, and we're all ready to go," versus somebody that comes in and says, "Hey, I haven't talked to a lender yet, but how much you offering on this house? Oh, 579.9. Yeah, we want to offer that full price." The weight behind those two offers are totally different. One holds weight because of the pre-approval, even though you still want to go and verify. But the other one is just a person that's saying, "Hey, I want to offer on this house. I don't have any extra information about it." So that's one thing to think about when you're thinking pre-approval versus pre-qualification. Go ahead and get that pre-approval. It doesn't hurt you. All right, it doesn't hurt you. Cool thing about it is once you're pre-approved, that letter is generally good for 60 to 90 days. So you get your paperwork and you are good to go out there and shop. You can put that number in your search on any website. You can go to homes.com. You can search on, inside of an MLS, any consumer facing website. Use those search terms to exactly know what you're looking for and find what property are going to be there. I'll give you a quick tip. In this market, start a little bit above your price because home prices are coming down and sellers are willing to negotiate a little bit. So the timing does matter whenever you're trying to seriously tour the homes. And if you do get outside of your 90-day window, it's generally a quick check by that same lender to, recheck your credit to make sure you're still good, and then they can resubmit a new letter. But here's the piece that ties plays 2 and 3 together, because there's always continuity in a playbook, right? We get one thing, we're able to merge into another play that looks similar, but it's going to be slightly different. Both the FICO and the Vantage score are going to treat multiple credit inquiries within a 14 to 45 day window as one inquiry. That means you can get those multiple quotes and, maybe you start working with one lender and maybe the relationship doesn't work for you, right? You're not really vibing. You can go off and work with somebody else and it's only going to count it as one credit pool so that you can shop with several lenders and get pre-approved in that same stretch of time and it won't tank your credit. That's the biggest myth I hear from buyers. They think that going to have multiple lenders is going to hurt their credit, and it's not. You're only going to have one pool. Bottom line on play 3, shop your rate and get pre-approved together in the same 2 to 3 week window before you start touring homes seriously. Because it's going to save you gas. It's going to save us all some time. If we're out looking at homes and we realize, oh, you're not approved for 570, you're really approved for 520, we need to reevaluate our search and make sure we're finding the proper properties that are going to fit your budget. Play 4 is good financial, wisdom in and of itself. But we got to definitely put a good play to it right here. So let's make sure we get this last play of the day. Gun empty, monsoon motion, deductible protection, umbrella post, 6-month wheel. It says hut. That's going to be on 2, all right? AKA start your rainy day fund, all right? Start your rainy day fund. And this is one I really want you to sit with and think about. Financial experts draw a clear line between 2 separate funds. There's general emergency fund that you hear about. having 3 to 6 months of expenses, like for cover a job loss, medical bills. If something happened that you had this much money set aside so that you could survive for that period of time. So that's like 3 to 6 months of living expenses. But I feel like your home needs to have its own fund that you're able to set aside and be able to use as well. It's something that's going to be separate from that. The most common guideline here is going to be a 1% rule. So setting aside 1% of your home's value every year for maintenance. So on a $300,000 home, that would be $3,000 to $9,000 a year, depending on the age and the condition of the house. Older homes, 30 plus years, often need closer to 3 to 4%. So you got to think there's more maintenance, there's more deferred maintenance in an older home. You got to consider having a few more bucks around to be able to address those things. But here's where it really matters, and what I want to add my own take to this on top of the research is several sources recommend a standalone reserve of $5,000 to $10,000 for big unplanned failures. You think about like water heaters, sewer lines, roof leaks. Side note, on the front end, if you're purchasing a property, we're trying to investigate and inspect the property to make sure that these things are in line and in good working condition before you purchase the property. And that's good general guidance, all in all, right? But here's a number I like to tell my clients. It's really easy for them because it's going to vary. I say, try to save your deductible. Try to save your insurance deductible, because if you're a first-time home buyer, you may not have the $15,000, $20,000 just to set aside. But if you're able to get your deductible set aside, and now a lot of insurance deductibles could be 1 to 2%, generally more towards 2% because of the way roofs are going in Texas. If you have a $350,000 house, then that's $7,000. So 1% would be $3,500. Then $7,000 for the 2%. So if you can get to that 1 to 2% number, or whatever your deductible is, if there is an issue where you need to file a claim, you will have the funds available to be able to pay that. Claim doesn't help you one bit if you don't have that money set aside first. So if you save your deductible before you worry about anything else, and you can build up from there. I also want to share this because why this matters so much. A HomeServe survey found that 25% of homeowners have $0 saved. $0 saved for an emergency repair. And I understand in this economy and the way inflation has been, things are totally different. So it's harder to save a couple of dollars, but you have to be more adamant about doing it. Of the ones who do have something saved, over half have $1,000 or less. So at least you have something. But you got to start setting some funds aside to be there in the instance you have to use something to take care of something of your property. And 48% of homeowners, almost half, had some kind of home emergency in the past year. HVAC failure was the most common at 20%, followed by plumbing issues. I know here in Texas, it's in the hot stretch right now, so HVAC systems are going to be put on a strain. You think about a few years ago, we had the snowmageddon and the ice freeze, and a lot of burst pipes and leaks were found, and pool equipment and things of that nature was damaged. Bottom line on Play 4, the question isn't if something breaks, it's whether you've got the cash ready for when it does. So start with your deductible and build from there. I do want to point out that when you are buying a property, inside of the contract, there's a space that's going to say that you want to be reimbursed for the purchase of a home warranty. We're going to negotiate that. I always want my first time buyers to have a home warranty, at least in their first couple of years when they are in a home, because you're just trying to learn what that whole system is like, right? You're not sure, how certain things work. You don't necessarily have cash to go and try to pay for a lot of repairs, but having a home warranty will give you peace of mind where you can call a company, they'll send out a contractor, and they'll look to fix it. Is it an end-all, be-all? No. Does it mean you're going to always get a replacement? No. They're usually there to just try to fix it and fix it alone and patchwork it together until that sucker don't work no more. But at least having a home warranty can help you. But let's run this thing back, make sure we understand where we at. 4 plays, 4 different numbers. Play number 1. 3 out of 4 buyers finance their home. So don't let the credit and down payment myth keep you sidelined. Get in the game. Play number 2, shop at least 2 or 3 mortgage quotes. Make sure you go out there and learn that shopping, that extra time is going to help you save some money over the life of the loan. Play number 3, get pre-approved in that same window, because multiple inquiries inside of that 14 to 45 days count as one credit pull. But also tell me this, if you are under contract, please don't just go off and change lenders. if you are going to change lenders, you can tell your realtor about it. Let them know and give them a heads up so that they can communicate it to the seller, right? So if you're under contract, I do not advise you to change lenders in the middle unless there's like something really bad going on, but then that has to be communicated because it can generally start your process all the way over. Okay, it can start it all the way over. Play number 4, start your rainy day fund with your insurance deductible as the floor, not the ceiling. After you've bought your property, yes, you have had a large outflow of cash. You're gonna have to start rebuild your way back up. So that's one thing to start with. Start with thinking about whatever that deductible is, so you can have that amount covered. But that's the full playbook, home buying 101, DFW style. Shout out to the good folks over there at List Reports for making this cool graphic. It's just that we can work with. So that's what I'm borrowing. I appreciate it. But that's the full playbook. Like I said, if this helped you and helped the process a little bit, made it a little bit clearer for you, drop a comment for me. Share with somebody who's starting their home search, and make sure you follow the page so you can stay up to date on the next episode. And if you want me to run your specific numbers, maybe find a loan type or some lenders, or what a rainy day fund should look like for you and your situation, the link's in the comments. I'll be happy to talk it through. I'm Anthony Armstrong, finding your opening. I'll see you tomorrow.